Welcome to Shadow of Truth, and today is Thursday, January 26, 2017, and your hosts are Dave Kranzler from InvestmentResearchDynamics.com and Rory Hall from thedailycoin.org, and we have a very special returning guest, the man himself, the big yellow hat, the myth, the legend, Mr. Craig Hemke from TF Metals Report. Craig, welcome back.
A very special, legendary myth. That's what I like that.
You got your hat on right now, Craig?
A little too tight, Dave.
Good. I call that your thinking cap.
And
you're assuming that math is still part of the equation.
Well, I guess that's true. That's a good point.
I mean, we know we can say with confidence that GAAP accounting principles, they're no longer part of the equation.
No, that's right. That's right.
And call it non-GAAP. I call it fraud, but they call it non-GAAP.
Well, and now that they've basically moved everything onto computer, and computers can be programmed to do certain things, maybe they can just keep it going on forever.
Well, I don't know that they can do that.
I hope not.
I mean, I really don't think that that's possible. Might be, but
my favorite topic these days is what's really going to happen this year. You know, is a dollar, and basically, I guess it revolves around the dollar and interest rates. I mean, are they both going to go up just like everybody says, or are they not?
Well, geopolitics too.
Yeah, that certain fits right into that discussion. You're right, Dave.
Yeah.
So
with what's just recently happened with the South China Seas, that seems to be getting ugly quick.
Yeah.
Craig, I have suggested that we're going to have a better year in 2017 in the precious metal sector than we had in 2016. And, that ties into this idea of where I think the dollar's going. Interest rates, I haven't made a final determination I don't have a firm conviction on it. I know that I think the short interest in the 10-year treasury now is like at a record high. It's the hedge fund algos. When they get something going, they just pile into it to the extreme. Yep. So that would suggest that rates may go lower temporarily. But there's not, as you know, there's not any definitive study that says there's a correlation between nominal interest rates and the price of gold. So I'm kind of agnostic about what interest rates do. What do you think is going to happen in the precious metals this year?
I think you'll know a lot in the next couple of weeks, frankly. We went up in 2015 under similar circumstances, where there was going to be a rate hike as soon as March and all that kind of stuff. And we failed at the 100-week, you could call it a 500-day moving it. We failed, like within 30 cents of it in January. And then rolled over and, the rest is history. And then last January, we went up and shot through the 100-week move for the first time since 2013. And then that was good. Well, we're back below. Well, as of today, we're back below it. Actually, as of yesterday, we got through it last week. And I thought, okay, well, now it's, crunch time. Now we're back below it. I mean, if we go down and start making lower lows, it's probably not a real good sign. And you know how I feel about, like you said, these computers just plunge into everything. And, what we call gold is just the COMEX digital derivative. And whether gold goes up or down is a function of HFT demand for that derivative. And what drives the HFTs into it on a daily basis, it's whether the dollar yen's going up or down. And so, to me, you boil it down that simply. So it becomes, in the end, it becomes a function of, what do you think the dollar is going to do? I'm going to talk to, on my show later today, Brent Johnson. You guys probably know he's out at Santiago Capital guy out in San Francisco.
Yep.
Good dude. Very good dude. And he just put out a presentation that was speculating that the dollar would just keep getting stronger and sucking in more and more assets around the world, because it's the only currency that's going up, and then our interest rates going up. And I just started thinking, I don't think that's the way it's going to work, but we'll see.
I agree with you. I mean, it looks pretty. It seems pretty obvious that the Trump administration is going to talk the dollar lower.
They've tried. Hell, it was just Monday that Mnuchin was saying that, and the dollar index may be flat, but they're doing everything they can to pump that dollar yen higher and keep it from making lower lows. And and then look what happened. What's the stock market up the last 2 days? 200 points.
But can they actually talk it down? I mean, do they have any power to control the Fed?
Well, that's the battle royale, man. That's Rocky versus Drago for this year. Trump's tries to talk it down, and Yellen talks it back up.
And what's been driving this? And I wanted to stay with gold for just a second. And this is for both of you. I mean, what's been the driving force of this gold beatdown, gold and silver both beat down over the past few days?
I have this reputation of being a permabull, and I suppose that's and I am. Frankly, I think everybody should be constantly buying some and putting it away for the day when all of this debt cycle finally collapses, which mathematically it will. I mean, we just know it's coming. We just don't know when. But there are times when you can certainly see that price is about to get maneuvered lower. And so we started talking on my site in the daily podcast that I do Monday and Tuesday and again yesterday, that prices were ripe for a pullback. Just because you could see all these forces aligning. One, here on Thursday, the 26th, we've got options expiration for the front month, February 17 gold. Monday brings what we call contract expiration, where the contract goes off the board and the trading activity shifts to April. And if you want to continue holding a February contract as it goes into delivery, you've got to have 100% margin in your account. So everybody gets, all these spec positions get blown out between now and Monday. And that's always a time of great manipulation because it's easy to manipulate. You take off a spread position and you leg it out, in parts to, you dump your long now and hope that you can buy it back, at $10 lower. So you always get manipulation around what we call contract expiration. Then we've got the FOMC next week, Tuesday and Wednesday, where there's not going to be Mother's not going to have a press conference, but that, there's going to be all this verbiage about, maybe as soon as March, there's going to be a rate hike. So we got that coming up. We got the employment report at the end of next week. And all the while in between, the Chinese markets are closed for the Chinese New Year. So we've seen how that usually doesn't help either. And you put all these things together and you think, well, clearly they're going to be coming after price. And then you start looking at the charts. And this is what made it almost a fait accompli that the last couple of days we'd go down. If the key determinant of price, what we recognize as the gold price in the short term, is how or if there is any speculator, high frequency trading, algo, hedge fund, whatever demand for the gold derivative on the COMEX and the other electronic exchanges. Key driver of that HFT demand is changes to not only just the dollar itself, but specifically the specific pair of the dollar yen. And if you look at both of those charts, they are, or at least were, precariously hanging on to support. The dollar index, everybody thought was going to the moon. And it shot higher after the election, peaked at about 103.5 the day after the FOMC back in December that had the rate hike. And it's been in a downtrend really since the first of the year and clinging to support at the really psychologically important, but also technically important 100 level. Well, hell's bells. What do you think is going to happen there? Do you think it's actually going to go through 100, or do you think maybe they might try to drive it back up? More specific to gold and to the stock market is the dollar yen, because these HFT computers focus so heavily on the dollar yen as to whether they're not only are they buying gold, but also S&P futures. And the dollar yen had come down dramatically. You can look at a chart, clear double top at 118, which was pretty stout long-term resistance. And it had been in a downtrend since the 2nd of January. Well, it came down last week and made a new lower low for this downturn trend at 112.55. It then bounced late last week as Mother was talking up the dollar. Remember that with her speeches that she was giving? And then it came back down Monday. And guess where it bottomed over the course of about, I don't know, 3 or 4 different attempts over maybe 5 or 6 hours late Monday? 112.55. And now, in the time since, it has magically moved high enough to break that downtrend, and it's about 2 points higher. That is why gold is down the last 2 days, because the dollar yen is back up 2 full points. And now we've just got to wait and see what happens next from here. I suspect gold is going to test its 50-day moving average. That was our initial target when we started talking about this earlier this week at 1180. It may even move all the way down to 1160, and then it'll be kind of a moment of truth. Either it'll kind of consolidate there, begin to paint what we call a reverse head and shoulder on the chart, or it won't. And then you'll have some idea where we're going in the near future.
There's a huge buying opportunity for gold and silver over beginning today and through the next few days. That's what I heard.
Well, that's kind of what I'm thinking. We've been at my site, we've been noticing it. We started to speculate that this would happen back in November when we saw the price of gold tracing with the yen almost on a tick by tick, 1-to-1 correlation. And it came falling down in November, as everybody knows. Well, that's exactly what happened in November of 2015 as well, ahead of that first Fed rate hike. And so we said, okay, well, let's just see what happens after the rate hike. Because in 2015, after that first rate hike, the price of gold bottomed the very next day. Well, guess what? In 2016, the price of gold bottomed the very next day on the 16th of December. And it moved sideways using the area around 1130 as support until December 23rd, when suddenly it began to rally, kind of surprised everybody, and rallied, what? Almost $100 by early this week, $90 in a period that saw maybe only 2 or 3 down days. So it was pretty impressive. Now, as this was unfolding, we noticed, okay, well, this mirror image to last year continues, because just as gold bottomed right after the rate hike in 15, it bottomed after the rate hike last year. It then rallied in early 2016, and it rallied in early 2017 as well, but it pulled back over the back half of that month and actually finished the month only up $50 or $60. And that's kind of what we're seeing now. We're pulling back. What are we, maybe $50, $60 off those December lows? And then when the action really began was in early February, when, if you recall, the Bank of Japan surprised everybody by announcing negative interest rates. The dollar yen initially spiked 2 or 3 points and then plummeted by 10 points, which meant that the yen was actually strengthened versus a dollar by 10%, which surprised everybody. And because of that, gold for that 10-day period back in early February shot higher, over $100 higher. But you remember that too. It was crazy back then. Whether or not that happens again in early February remains to be seen. But much of this, I mean, it's not a mirror image of last year for no reason at all. I mean, there are a lot of reasons why this year looks a lot like last year. And now we just have to see if this all continues to play out that way.
Yeah, Craig, I agree with you. Everything you said, there's 2 things. First, the other 2 factors here with gold is the upcoming FOMC meeting and the jobs report. And you got those both in the same week, and each event independently is usually, they usually take gold down before that happens. In terms of the Chinese New Year, now everyone's aware of it. A lot of people used to never even be aware of it, but last year during the Chinese New Year week off, gold was volatile, but it moved laterally. It wasn't really down. So I don't know how much of a factor that'll be, especially because India is importing gold again. So
yeah, Dave, the only thing I'd add, Dave, is there's a second period in the fall where they take a whole week off. That's called the Golden Week.
Yes,
in October. And
I agree with you. We get hit then.
Yeah, those last 3 been. So we'll just see. Hopefully, I think everybody listening would say, "Hey, volatile but sideways." Okay,
Yeah, you know what? For me, I don't care if they take it down because I raised cash in our fund last week, and I'm gonna jump on stocks once, probably toward the end of next week. The thing and we don't have to talk about this unless you want to. What I'm always curious about, and I agree 200% with the relationship between gold and the dollar yen. But what I've always been trying to figure out is, what's the catalyst that drives the dollar yen? And I think it's that big carry trade that was put on over time when Japan took its interest rates to zero, and everyone in the West was borrowing yen at no cost, or next to no cost, and putting on a carry trade in their either euros or dollars, primarily dollars. So you've got this massive portfolio out there, let's call it a massive hedge fund in aggregate of all the hedge funds, et cetera, who have this short yen, long dollar trade on. And it was never really written about, but a couple months ago, I can't remember if it was the head of the Bank of Japan or the Prime Minister of Japan who said, we might have to start raising interest rates over here. And if Japan even hints that it's going to raise interest rates, you're going to see a big unwind in that dollar yen.
Yeah.
And that's one of the catalysts. And that's just one of the catalysts that could cause the dollar to go down a lot versus the yen and really propel gold.
Yeah. And drive that dollar yen lower, meaning driving the yen higher, and make gold go shooting higher like it did last year. No, you're absolutely right, David. Again, it's that relationship and that known, I guess, that was written into the vast majority of these HFT programs. And again, people should have to understand that's what these markets are in 2017. It's not a collection of you and me and Rory and a bunch of other guys looking at their screens going, oh, I think I'll buy 200 shares of Coca-Cola here because the fundamentals look good. That's just not how it works, man. And so the central bankers, which we all know are now in the business of propping up their system for as long as they can. The central bankers know this too. And so they know if they want to get the desired result, if they want to create the proper illusion, if they want to maintain perceptions of growth and this robust economy by virtue of rising equity prices, they know then that if they can control the inputs, they can get this to happen. They can get these HFT machines to buy the mini ES and the other S&P futures by maneuvering the inputs. And again, the key input, anybody can, as you just mentioned, Dave, why it is there. Anybody can see this on a daily basis. One of the key drivers of getting these machines to buy S&P futures is the dollar yen. And the VIX plays a role as well. There are a number of things that the central banks can directly manipulate to get the desired result out of these computers, make the computers do the heavy lifting for them. And so when we see, like I said, you watch the dollar yen come down last week, make a new lower low at 112.55, and then bounce back up to near 114 as Mother was speaking Wednesday and Thursday, and then come all the way back down to precisely 112.55. Now, there's an inclination there to say, well, it might just be one hedge fund that, putting up support there and buying and find. No, man, we're talking, this is the Forex markets are 5 to 7 trillion with a T, $5 to $7 trillion of dollar volume a day. To completely stop at a precise point and then reverse a Forex pair as major as the dollar yen can only be done by a central bank, whether it's the Bank of Japan, Swiss National Bank, the ECB, some traders at Citadel for the Fed, whatever. But they know that if they don't want to see that dollar yen make a new lower low because all of a sudden, ooh, look at the trend now. Ooh, it's really coming down. And ooh, that sets a target of 110. And so anyway, these central banks, in their efforts to continue the illusion that everything's fine, they now know they can manipulate markets by simply manipulating a few of these HFT inputs. Dollar yen is key to just about everything. And so they do. I'll give you one other thing that I've been thinking about here for the last couple of weeks. And it's the idea of, in my mind, I haven't written about this yet because I haven't I haven't had the time actually, but the idea that I'm formulating, I just call one chart. And it's not a universal chart for everything from IBM to soybeans, but this collapse of cross asset correlation, at least the major items, the important ones, are all collapsing basically into one chart because of this advent of HFT control and the central bankers trying to manipulate a certain outcome. You can see it on the intraday basis often, like I said, of S&P futures or gold moving with or a one-to-one correlation with the yen. You can also then begin to see it on a longer term perspective too. And what really got me thinking about it, somebody posted on my site a couple weekends ago, somebody just wrote in the comments, what's weird? Can somebody explain this? Here's the Canadian stock market in candlesticks, and here's U.S. high yield debt in bars. Why are these two precisely one-to-one correlated? It doesn't make any sense. It does when you look at it from the one chart perspective, the HFT domination perspective. That's kind of where this is headed, I think. And again, please don't take this out of context, anybody, and think, Turd Ferguson says that soybean oil is closely correlated with Apple. No, that's not what I'm trying to say. I'm saying that in a broad sense, these central bankers in the desperate perpetuation of their system, whether it's from, QE and changing accounting rules and all these other things that they've done over the last 8 years to inflate and prop back up the system. They're now, since almost everything is predominantly traded by high frequency trading computers, they figured the game out. Why? Did you guys see the story yesterday? About 80% of the world's central banks plan to increase their equity holdings. Did you see that?
Yeah, I saw that.
Setting aside whether central banks should own equities in the first place. I'm not even going to go there. Do you think they're in on the game? All these central bankers, right? Yeah. And so they know. I mean, they understand that the major central banks are propping up the equity markets. And if you know that the game is fixed and rigged, well, then suddenly buying equities is as riskless in your perspective for your balance sheet as buying sovereign debt used to be. I mean, that's how these pieces begin to connect together. So anyway, I really went on a tangent there, Rory. I had too much coffee.
That's good.
Okay. That's good, Craig. In terms of that, the cross correlations you're talking about, I've been thinking about that for a long time. And someone wrote an article about it last week, and they had a graph showing that. Yeah. And I think Zero Hedge had it posted, but they weren't the source of the information.
No, it was a Goldman Sachs or a JP Morgan or somebody's chart. I had it on my side too.
Yeah, and so you're seeing that the correlations among asset classes that we've had over the last several years starting to break apart. And it's clearly, that right there tells you that, the central banks can control things for short periods of time, but ultimately no one can control markets for a long period of time. And what is really fascinating to me is there was a couple days last week, and I haven't been paying attention to it this week, but there was a few days last week where the VIX was up and the Dow and the S&P were up. And that really kind of makes no sense. But to me, it illustrates this idea that the cross correlations are starting to blow apart.
It'll be interesting to see. I mean, that would be your sign that things are getting pretty dicey if that's the case.